personal details, so please do not take any of this information as a personal advice. Obviously, we do recommend you seek financial advice when it comes to making these decisions and working out how they affect you. So who is Atlas Wealth Management? We're the first and only Australian financial services firm to specialise in providing financial advice to Australian expats. We currently have the pleasure of looking after clients in over 18 countries, from America through Asia, Europe, and many other smaller countries as well too. We have been nominated as a finalist as well as winning in a number of domestic and international awards. We're very proud of the work we do in this space, and it's something that we hope it shines through in what we're trying to achieve. Who am I? I'm the founder and managing director of Atlas Wealth Management. I was fortunate to receive the Innovator of the Year award last year from IFA magazine for the work we've been doing with Australian expats. From time to time, we get called on by the press to provide commentary both around basic financial advice, but also to specifically expat financial advice. And we've had the pleasure of working with a number of the major headline media agencies. The 2017 budget, there wasn't a lot of changes, but to me, there never was going to be a lot of changes given the amount of goalpost moving we saw in the last two budgets, both in 2016 and 2015. So as a financial advisor, there's been a lot of work going on in the background preparing for the upcoming changes that were announced last year, but there are a couple of very large changes that do affect expats, and we'll run through those this evening for you. So when it comes down to the personal tax side, there's been no major changes to the income brackets for either residents or non-residents, and I think given the amount of changes we've seen in years gone by, they probably wanted to leave this one alone and let it settle down. So essentially when you're working out your numbers, it's going to be based on the same numbers or same percentages as that occurred last year. The only real change that occurred for expats who are classified as a resident for tax purposes is there will be an increase in the Medicare levy from 2 to 2.5%. So not a major difference there. We're not going to see a lot of changes with respect to this. There's been a lot of talk about bracket creep and a lot of different changes going on with respect to the average percentages of what bracket they're in. And I think the government's just trying to probably buy a bit of time before they start to move those numbers around. As we saw from years gone by, there has been quite a bit of tinkering here. And for us, it was a budget that was delivered in order to be effective. And when I say be effective, many of the budgets in years gone by, there's so many changes that half the changes that were announced or proposed never actually got through either the House of Representatives or the Senate. So I think what we're seeing out of this budget right now is a budget which the government has a bit of confidence that they can actually get quite a bit through and be enacted in legislation. So that's why we haven't seen a lot of tinkering on that side there. This is probably the biggest change with respect to expats that we're going to see and that we have seen since probably the announced changes back on the 8th of May 2012 when the federal government removed the 50% capital gains discount around investment properties held by Australian expats. And that is non-residents will be denied access to the capital gains tax main residence exemption from the 9th of May 2017. So virtually from budget night last week, if you are, and let's take a step back. In the past, if you were an Australian living in Australia and you decide to move overseas, you essentially had 6 years up your sleeve to be able to move overseas, put a tenant into your property in Australia, still receive the main residence exemption, and what that meant was you could sell that property within that 6-year period from moving overseas and not pay capital gains tax. And it's been a great benefit from Australian expats because quite often what we found was, you know, there's sort of two schools when it comes to the Australian expat. And the first is the sort of short-termers and then there's the long-termers. So the short-termers, they might go overseas for 2 to 5 years and then come back to Australia. So what they could do was live in their principal place of residence, move overseas, enjoy the expat lifestyle, put a tenant in their property back in Australia, and then come back to Australia within that 6-year period, move back into that property, and they weren't subject to non-resident capital gains tax with respect to property. this is where everything's changing right now. So let's run through a scenario of a couple who are about to move to Hong Kong or San Francisco or London, and they decide to do that on the 1st of June 2017, next month. By moving overseas, they no longer are able to gain access to the 6-year rule. So what it virtually means is the property is going to be treated no differently than an Australian investment property for investment purposes, and you will start to accrue capital gains tax from the time that you move overseas. For those who are already overseas, and this is probably the biggest question we're getting right now from clients, is the existing properties will be grandfathered until the 30th of June 2019. So what that means is we've got until then to determine what the effects will be. We obviously haven't seen the fine print when it comes to this legislation. Essentially, the way the budget works, they make these announcements, and then in the weeks and months after, they will then prepare and send through the information when it comes to how different structures and different scenarios will be taxed. So long story short is, if you have only just moved overseas in the last couple of years and you still have a couple of years to go, you still have that main residence exemption up until the 30th of June 2019. After that period, you'll then start accruing capital gains tax, regardless of whether the full 6-year period or not has been utilised. So we'll be finding out more information over the coming weeks and months as to how this is going to work. But obviously, what we're going to start to do is put together a bit of a war package for clients and say, rightio, these are the considerations you need to take into account with respect to your property. We are fielding a lot of questions from our clients, especially given the heightened Australian property market right now. We're trying to work out what is in their best interest. We often talk to clients about, do they intend to return back to that property? Can they take advantage of that 6-year window whilst they're overseas and maybe sell that property? And if they're going to move back to Australia, are they going to move back to a different location? In that case, they might be inclined to make different decisions than, say, someone who is intending to return back to that property back in Australia. Obviously, the biggest thing what we're looking at right now is for those people who are looking to buy property at the moment and then rent it out and then move back into it at a later date and make that become their principal place of residence. Obviously, from the period that you purchase that property until you become an Australian resident and it does become your principal place of residence again, then you will accrue capital gains tax under the non-resident marginal tax rate and the tax regime that falls through from there. The capital gains withholding rate, this is something that was introduced last year, and essentially what it was if you are selling a property in Australia and an Australian resident is buying that property, what they wanted to do was for properties above $2 million, then the seller would have to retain 10% of that property value and pass it on to the ATO on your behalf. And what this was the ATO was quite concerned about non-residents, and that may be Australian expats or foreign citizens who own property in Australia, selling a property at a capital gain and then repatriating all the funds back to Australia, to overseas, but obviously not paying the requisite capital gains tax if any gain was accrued in that property. So now what's happening is they're going to lift that withholding rate from 10% to 12.5%, but this is the most important part. The threshold is reducing from 2 million down to 750,000. So what that means is if you own a property in Sydney and Melbourne, more often than not that property is going to be worth more than $750,000. If you do sell that property in Australia as a non-resident, then very likely if that seller understands that you are a non-resident, then they will be required to hold back 12.5% of the proceeds from that property and pass it on to the tax office on your behalf. So essentially what it means is, there's more paperwork that's going to be going through. Obviously, there's a number of different mechanisms that we work with our accounting colleagues when it comes to how the cash flow works with these sort of things. But obviously be aware of that. If you are selling a property in Australia and you are selling it to a resident, then more than likely they're going to start to pull money off you if they are aware that you are overseas. Next one is the student debt, and this has been causing a lot of conversations and confusion out there in social media land. We obviously monitor most of the major channels, and we actually did a video on YouTube last week because there was a lot of confusion, we actually nutted down who's required to do what. In this year's budget, they've announced that they're actually going to reduce the threshold. At the moment, it's sitting at 54,869. That threshold is reducing down to 42,000 from the 1st of July. At the moment, with 54,869, the repayment rate is at 4% of that level. From next year on, from the 1st of July 2018, the repayment rate is going to drop down to 1%. So what it means is virtually, at the moment, if you do have student debt, but your overseas income falls below 54,869, then there is no requirement to make a repayment on your HECS, HELP or TSL debt. However, from 1 July 2018, even if you own below 54,869 but above 42,000, you're still going to have to start making repayments on that student debt. There also will be a new maximum threshold set at 119,882 Australian dollars with a 10% repayment rate. So at the moment, the maximum threshold is sitting at about 101,000 with a repayment rate of 8%. So you can see they're really trying to drill down and claw back as much money as they can on this. You know, also note that changes to all Australian expats with student debt will be coming into force on 1 July this year. So there is a lot of confusion as to how the mechanics work behind this. I encourage you to go to our YouTube channel, which is www.youtube.com/Atlas Wealth MGMT, and we've done a number of videos there on the HECS and HELP debt situation. Have a look at that, because even if you do fall below 54,869, you still have a reporting requirement if you have student debt back in Australia. Superannuation, there was no major changes announced this year, which is a bit of a relief, because last year there was a lot that went through and there was quite a number of double backflips and triple backflips with respect to different mechanisms inside the system. So that's a good thing for clients. One of the major changes that were announced with respect to super is for those expats who have a self-managed super fund that invests in property using debt. So what this is if you have borrowed off a bank inside a self-managed super fund and you've done what's called a limited recourse borrowing arrangement with the bank, the super changes announced last year with respect to the non-concessional caps, the government is now including the debt levels inside those caps. So if you do have a self-managed super fund that does invest in property and you do have debt, you do need to have a look at that as well. Also, please be aware of the changes that were announced last year that come into effect on the 1st of July. There are a number of changes that may affect expats. Quite often expats use what's called the concessional cap contribution method, where what you can do is make a concessional contribution, which is pre-tax dollars, into your super fund at the maximum rate, and try and offset that against your Australian rental income on an investment property. Those caps are reducing, so please be aware of from 1 July this year, or in a couple of months' time, those caps will be reduced. You do not want to breach those caps, because it just includes an extra layer of hurt when it comes to managing your super. The other things too that come in on the 1st of July is the reduction in the non-concessional contribution allowance. So at the moment, up until 30 June this year, you're able to contribute 180,000 Australian dollars into your super fund every year. As of 1 July 2017, that is reducing down to $100,000. So if you are in your later years and you're making a concerted effort to build up the balance in your super fund, be aware of that, because that does change on the 30th of June. Obviously, for those who are below the age of 65, you are able to use the bring forward rule. And what that means is you can essentially make 3 years worth of contributions in 1 year. So at the moment, because the legislation is sitting at $180,000 per year, you're able to make 3 times $180,000 contributions up to $540,000 before the 30th of June this year, even though the concessional cap is changing on the 1st of July this year. So that's quite a good opportunity that clients are taking advantage of to try and build their balance up inside super. By the way, the $1.6 million cap is per person, not per couple too, so that always needs to be taken into consideration. With respect to pension, we do get quite a lot of requests from those expats who do want to stay overseas and they do want to draw on an age pension if they do qualify. The Australian government over the last 2 years has really made this an area of focus with respect to trying to reduce the amount of overseas payments they're making on the age pension, and the announced changes certainly go even further again. So the residence requirements for the Australian age pension and also the disability support pension are increasing. Under the proposed changes, you will need to have at least 15 years residence in Australia, unless you have either 10 years continuous Australian residence with 5 years during your working life, or 10 years continuous residence and not have been in receipt of an activity-tested income support payment for a cumulative period greater than 5 years. So you can see here they're just really drilling down. Our conversations with clients, we've always said do not rely on the Australian age pension as part of your funding vehicle to fund retirement, because in future years we can see the age pension being whittled away, and there is a very real risk that by the time you get to that age that there is a chance that it actually may not be there. So make sure that you do everything you can on the other side to try and ensure that you're not relying on that pension, because I think there's a pattern emerging here. Every year we're seeing the difficulties in applying for the age pension getting harder and harder. I've just left my contact details on the screen there. Should you want to get in contact later down the track, if you have any further questions, please feel free to email me at brett.evans@atlaswealth.com.au. And for those who weren't able to join us tonight and who are watching this via the recording, please don't hesitate to reach out and ask any questions down the track as well too. Fantastic, guys. Well, have a great evening, and we'll look forward to talking to you later on.